Today, the rental crisis worsens. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, there's a lot of noise and discussion about the pressure on mortgage holders, but unfortunately the conversation that should be taking place about rents and rental stress are rather detuned and defocused. I wonder why. Well, maybe because lots of vested interests are really only interested in flogging more properties and more loans to householders. And the rental sector is regarded as a very poor second best. And yet, 1/3 of all Australian households now live in rented accommodation. And the story is one of growing rental pressure with very little escape routes at the moment and more pressure ahead. But there are many contradictions in this story. Now, I think any discussion about rents and specifically rental stress should probably start with my data. In fact, yesterday I published quite a detailed mapping exercise where I showed specifically how rental stress is spread across the country. But let me just recap this because it is worth understanding that rental stress has shot through the roof. In fact, 61% of households are now in rental stress. Now that's measured in terms of cash flow, so money in and money out. 61% of households have insufficient income to cover all of their outgoings, including the rent. And just for comparison purposes, back in 2020, 33% of households who were renting had difficulties. So this is a massive situation. It's nearly doubled in just 2 years. And there are a whole bunch of reasons why that is the case that we're going to go into in a bit more detail. But this is a very, very unsatisfactory position. More people are struggling to make rents work. And in fact, in our analysis, and as I discussed in more detail in a recent post where I went through this, mapping it across the country, more than 1.9 million households are in rental stress across the country. That's why it's 61%. And if you look across the states, you can see that rental stress is highest in New South Wales and in the ACT. It's pretty high in Tasmania and Victoria and Queensland, and it's a little lower in Western Australia, South Australia, and it's lowest in the Northern Territories. But of course, that's a very small number and might be somewhat distorted. And another way of looking at the same data is to look at the average percentage of rental stress by different household segments. We look at this from a point of view of different cohorts. And we'd like to make the point here that multicultural establishment, which are first-generation Australians, are the most highly exposed, together with wealthy seniors and young growing families. That said, even more mature, stable families are also finding it awkward, as well as those on the urban fringe, and even some more affluent households are also finding it difficult. So this is an issue that is definitely spread well across the board. That's why the mapping was so interesting. Now, just to recap on what I said the other day, rental stress is highest if you count the number of individual households recorded in rental stress in the Melbourne postcode of 3,000. Then Toowoomba with more than 10,000 households. Then Liverpool with more than 9,000. Then up in Queensland around Labrador and Southport at 9,000. And then back to New South Wales around Campbelltown. And another New South Wales postcode including Mount Druitt. Then back up to Queensland again. And we stay in Queensland for a couple of postcodes, but then go across to Victoria to Hoppers Crossing. Then back to New South Wales to Waterloo and Zetland. and then Blacktown in New South Wales, and then back down to Victoria, including Donnybrook and Mickleham, and Queensland areas around Ipswich are also there, and even in that area there are more than 7,600 households in rental stress. And I'll just make the point too that if you look at the proportion of those renting in terms of rental stress, you can see that some of them are pretty outlandish. For example, if you look at postcode 4207, 89% of households are actually in stress from a rental perspective of those renting. And if you look at Craigieburn, Donnybrook, Mickleham, Roxburgh Park in Victoria, 3064, 83% of households are having cash flow issues. And I will make the point that a lot of these areas are actually newly developed suburbs with a lot of new people moving in. And quite often it means that they're, of course, paying the higher rents that are now being asked. But also the other factor here in these outlying areas is that the costs of getting around and the general cost of living are also a lot higher, which puts more pressure on those households. Now, let me go on then to talk about the ABS, because the ABS released their monthly estimate of inflation the other day. And for them, over the last 12 months, from August 2021 to August 2022, they say that overall rents rose 2.4%, which is actually quite low and well below general level of inflation, which is at 6%. However, the question is that the true story? Well, if you look at this chart, which shows the difference between what the CPI report is and what CoreLogic or SQM is showing in terms of rental increase, you can see that there's been a massive run-up from CoreLogic and SQM relative to the ABS. Now, the reason for that is that CoreLogic and SQM are reporting current listed, i.e. available rental properties, whereas the CPI from the ABS is reporting all of those rents, including those that are quite old. Some people have held the same tenancy for quite some years. But of course, the other conclusion of that is that we would expect inflation from a rental perspective to rise significantly as more of these new rents flow through into the ABS statistics. We'll watch that with interest. And this is another way of looking at the same information, and it shows that the ABS historic data is very, very much lower than the CoreLogic average or indeed the SQM average. Now, the next thing I want to go on to is to look at another very important dimension here, and that is, of course, that most rental properties are being offered by property investors. We've really outsourced homelessness and investment properties and the renting sector from the public sector to the private sector to individual investors and also firms and corporations that also offer investment properties. There are some very unfortunate consequences from doing this, though. And here is an example looking at data from my core model. So first, I'm going to show you the profile of gross rental yields across the country. And you can see there that there are a few postcodes. Each of these is a separate postcode. I've just shown it by the state they're in rather than individual postcodes. So some, small number, have a gross rental yield of around 6%, which happens to be, of course, where inflation is. But most of the time, gross rental yields are well below the current level of inflation. And just to be clear, gross rental yields are defined as the difference between the cost of a property, if you went and purchased it today, relative to the theoretical full rental that you could get if you lent it out today. And what's interesting, of course, if you look at this chart in more detail, is that the gross rental yield drops significantly, and some are just around 2% or slightly higher. And if you look carefully at the state mix, you can see that the higher gross rental yields are in places like Tasmania and Queensland and Western Australia. Some of those in the middle are South Australia, New South Wales and Victoria. But as you go down to the lower echelons of gross rental returns, you can see that both New South Wales and Victoria are where the centre of gravity is. And this is what we find from our analysis too, that in fact the gross rental yields are highest in places like Queensland, Tasmania, and then Western Australia and South Australia, but they're lower in New South Wales and Victoria. And by the way, the ACT has tended to have high gross rental yields too. But now let me overlay this, because this is the actual true net rental yield. So this is what's happening when you take account of things like mortgages on the loans that property investors have, the property maintenance costs and the property management costs, and also vacancies if they exist. And you can see that there's a considerable dynamic movement across the postcodes, and in some cases the net rental yields are severely negative. In other words, people are significantly underwater. But you can also see that on average we're looking at the net rental yields of perhaps around 2%, best case, but that they drop quite quickly to zero and to well below zero. And in fact, more than half of households have a net negative rental yield. In other words, they're losing money on their investment property from a cash flow perspective. And let me just recap, because it's important to understand this, bearing in mind inflation is about 6% at the moment, which is up here. Anybody who is investing in property from a cash flow perspective at a gross and net yield perspective is more likely to be underwater, and the true measure of net rental yield shows that many people, more than half in fact, are significantly underwater. So people are losing money. And that's a really important observation, of course, bearing in mind that currently home prices are dropping. So property investors are expecting and need to expect to see capital values reducing. Now, of course, in the longer term, that could up slightly the gross rental yield, because it means that if you bought that property today, you'd be buying it for less. But it does show you why there is so much pressure on new rents being put up by property investors, because they're trying to recover some of these losses, particularly when there's no capital appreciation. And so we're seeing two observations. The first observation is that many households are choosing to get rid of their investment property, put it on the market, release the capital and get out. And others are trying to stay in, but are pushing the rents up significantly. And we see quite a lot of examples now where the rents are being lifted by 10 or even 15%. And that, of course, is putting more pressure on those in the rental sector who often have nowhere else to go. Which takes us quite nicely to the CoreLogic data, which came out today with their quarterly rental review for the third quarter of 2022. And it shows that the National Rental Index has its smallest monthly increase this year, up 0.6% in the month of September, and translates as 2.3% over the September quarter. That's a 60 basis point decrease on the 3 months back in June when it was 2.9%. And they said that the annual trend in national rents recorded double-digit growth over the 12 months to August for the first time since CoreLogic records commenced, with the annual trend holding steady at 10% over the year to September. So let's be clear. Total rents, according to the ABS, is just over 2.6%, whereas CoreLogic is saying new rents are actually holding at somewhere between 10 and 12%. And they went on to say that the past few years has seen unprecedented growth in rental values. Initially, they were driven by a reduction in the average household size. The continued upswing in values is likely now predominantly being driven by the strong return of overseas migration, coupled with extremely tight rental supply. In fact, they said supply continues to be an important factor impacting rental markets, with the total supply of advertised rental stock down 35.4% below the previous 5-year average over the 4 weeks to the 2nd of October. And additionally, national dwelling vacancy rates tightened from 1.3% in June to 1.1% in September. That's the lowest national vacancy rate on record. And worsening affordability has seen rental demand shift away from the more expensive house segment towards the more affordable medium to high density sector, as the sustained period of strong rental growth coupled with high non-discretionary inflation has pushed more renters up against affordability constraints. Worsening rental affordability continues to put downward pressure on the pace of growth in house rents, though, while the return of overseas migrants, where demand is typically skewed towards capital city unit markets, is helping to bolster demand for unit rentals. Rental growth across the combined capital cities continues to outpace rent rises across those combined regions. And CoreLogic said that this trend was largely owing to that return of overseas migrants who typically choose to rent in high-density markets of Sydney and Melbourne upon arrival. Rental growth in the combined capitals was up 2.7% and 1.3% across the regions over the 3 months to September, while both markets saw the pace of quarterly growth ease compared to the June quarter. The decline in the rate of growth seen across the combined regional markets was significantly stronger, they said. However, despite the easing growth trend, rental availability in both markets remains extremely tight, with the capitals recording a monthly vacancy rate of 1.1%, while just 1% of regional rental properties were observed as vacant in September. Now, looking across the capital cities, Brisbane recorded the strongest quarterly rise in dwelling rents at 3.8% for any capital city, despite the pace of growth easing from the recent peak rate of growth of 4.2% recorded over the 3 months to August. Adelaide and Darwin both recorded an increase in rental values of 3.6% over the quarter, while Sydney, Perth and Melbourne saw dwelling rents rise 2.9%, 2.5% and 2.3% respectively. Canberra was the exception, with dwelling rents declining 0.4% over the 3 months to September, due to a 0.9% fall in house rents. And rental values across Hobart rose 0.4%. That's an increase on the 0.1% rise recorded over the 3 months to August. Despite recent declines, Canberra maintained its position as Australia's most expensive capital city rental market, just with a median weekly rental value of $682, followed by Sydney at $665 per week, Darwin at $590 per week, and Brisbane at $573 a week. Melbourne retained its position as the most affordable capital to rent in at $495 a week, followed by Adelaide at $508 a week, Perth at $533 a week, and Hobart at $551 a week. And they said, with Sydney recording strong rental growth at a time when rents are declining across Canberra, the gap between Australia's two most expensive rental markets has narrowed to just $17 a week, they said. Given international migration is expected to continue to support rental demand across Sydney, while affordability is expected to hamper Canberra's rental growth, it's likely we'll see Sydney overtake Canberra as Australia's most expensive capital city rental market in the coming months, they said. And it's also worth noting that gross rental yields did continue to expand, with rental values rising as housing values depreciated. National dwelling values fell 4.1%, while national dwelling rental values rose 2.3% over the September quarter, resulting in a rise in dwelling yields of 24 basis points to 3.57%. And CoreLogic said that while yields are above the record lows recorded in February of 3.21%, they are still well below the pre-pandemic decade average of 4.24%. With interest rates expected to continue rising throughout the first half of 2023, it's likely we'll see further downwards pressure on housing values, CoreLogic said. In this scenario, it's likely rental yields will continue to improve, with the combination of continued rental growth and falling values being a potential catalyst for national dwelling yields to return to long-term averages, which could help offset the highest mortgage costs investors are facing. Once interest rates have stabilised, they said, higher yields coupled with lower values and stronger buying conditions could entice more investors to enter the market, which would ultimately help raise rental supply. Well, of course, they would say that, wouldn't they? But the truth is this, many property investors have done the calculations, and now they're making an assessment that even if they can put the rent up a bit, their costs are not going to be covered by doing so. And they are conscious that capital is being eroded because values are being reduced. So more property investors are now seeking to put their property on the market and quickly to sell and get out and crystallise the capital that's been created. This, of course, is going to put even more pressure on the rental market because the total number of rental properties available across Australia continues to decline in the face of higher migration and bigger population growth. So this is a market that is completely broken. And it's been broken because of three reasons. Firstly, because the governments, both state and federal, have basically left it to the private sector to sort out rental accommodation. They should, I think, be doing a lot more with regard to affordable housing for those who need to rent. But of course, politically, they don't want to go there. Secondly, the way that the tax system works, property investors, in theory, are getting benefits, but those benefits were eroded significantly because of some of the changes, and also the fact that negative gearing works less well when interest rates are low. It works a bit better now that interest rates are going up. But thirdly, many households who have investment properties are also the owners of properties over which they have a mortgage too, where they live. And so their cash flow pressures are being driven not only by poor performing investment properties, but by pressures on their main residence too, because inflation, of course, is biting quite widely. And so some property investors are deciding that this is a good time to get out. And whilst if you read the media and some of the portals, they keep claiming that now is a great time for property investors to pile into the market, I would say, no, it's not. All my calculations, all my interviews with individual property holders, and all my modelling shows that most property investors are losing, and losing big time at the moment. And that means that pressure on the rental sector will continue. More people will end up being homeless because of the 20-odd years of bad policy that's been executed. And there really are no good conversations in terms of real solutions being offered by the government, nor indeed by the private sector either. So the bottom line is this. In my view, everybody is just playing lip service to the rental problem, but nobody really wants to get close to tackling it. Another case of massive policy failure. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.